This is our Forex blog for June 4th, 2013. And one of the easiest ways of trading is using our currency index, which basically means we compare, for example, all the euro pairs to every other one and create a chart of that comparison. It's kind of like a Dow Jones Industrial Average of each euro pair. So we're looking at the euro dollar, euro yen, euro Swiss, euro CAD, euro Australian, euro pound, euro New Zealand, euro CAD, all of them. And it basically lets you see visually the trend of each currency. And so if the dollar's going up and the euro's going up, you probably don't want to trade the euro dollar. You want to buy the euro versus maybe the Australian, which is trending down. So this is how easy we've made trading. The euro's going up, the Australian's going down, so we're looking to buy the euro Australian, which is not surprising, exploding up 34.25, 35.50, 125 pips. Basically, you had this nice little entry right here, trend line break, and a little flag pattern right here, breakout. You don't want to get in the habit of buying above our upper 2.0 white containment bands. These are made up of our digital signal processing based moving average. Hourly moving average is shown here in the middle. The DSP moving average is much faster. It's kind of in the middle. It's significantly faster than the regular moving average, and therefore the bands adjust very quickly. But you can see that the euro going up, the Australian going down, especially at 2 o'clock right here, it found resistance at the hourly moving average of the Australian index. You sell it. The Australian was going down, the dollar broke out to the upside. It was above its hourly moving average, so the filter is telling you to buy. This one's underneath its hourly moving average, the filter is telling you to sell. Australian dollar. Weak Australian, strong dollar means this thing's going down. Notice 2 o'clock right here. Had a little breakdown. You might consider this sell right here, this little sideways rectangle pattern right here. You wait for a deeper pullback. And really, some of the best trades are ones that, when you draw your fibs on it, the 38 to 50% level, the upper Bollinger Band on our perfect oscillator, oftentimes is the end of the move. And when different tools all line up and give you the same general area to look for sells, you will find very high probability trades. For instance, like I said, 38% fib level, it comes up and hits the upper Bollinger Band. This is a downtrend, pullback, counter trend pullback. You go short, put your stop above here. And more than likely, when it comes down and goes sideways for half an hour, I'm going to get out of this trade. When it comes back up again, you can see it's above the perfect oscillator again. You go short, you have a small 4 to 10 pip profit on the first trade. Second trade's working. You might look to get out of that trade when it breaks that trend line there. This is the previous low, so unless it breaks that low, you don't know to use this next fib target. But notice how that fib target acted as a profit target, and the perfect oscillator is below the lower Bollinger Band on the perfect oscillator. Very high probability reversal. You can use these for many predictive ways as well. In fact, for example, you can draw a trend channel on a trend, then project it from the high, and usually when price hits the upper quadrant, it's going to be over. That's the end of the trend. And especially when the Swiss here goes above its previous day's high by just a few pips, fails to stay above it, comes back down, very high probability place to go short right here at 8. So at 8 o'clock, what's the strongest ones to buy? You can see the euro looks to be breaking out above the previous day's high. The dollar is also finding support here at the hourly. The Swiss has gone up, and it's gone up a lot. It's likely to pull back. The dollar has trended up earlier and pulled back and found support to hourly. So I would say at 8 o'clock, buy the dollar Swiss. Now, if you're wrong, you're going to lose 5 to 10 pips. 8 o'clock. Here's 8 o'clock, and like I said, the dollar had been pulling back. The Swiss had been getting strong. You can also see the perfect oscillator at an extreme right here. Usually when the plus 80 and the minus 80 is a high and a low of every swing. But they don't get hit that often. Occasionally, especially during dead times of the day, they get hit and the market can continue. Anyway, 8 o'clock comes by, you buy this breakout right here, and even if you made 10 or 20 pips, it went up about 45 pips, you would have made money on that trade by just simply buying or selling a currency that's likely to reverse against one that has pulled back and is likely to go up. Let's look at 8 o'clock buying the Euro Swiss. Strong Euro, it looks like it's about to break out over the previous day's high. The Swiss is likely to pull back. 8 o'clock, the Euro Swiss is likely to go up. And you can see it does. You know, this one had been trending up, pulled back, went slightly underneath the hourly moving average, just kind of chopping around on a nice little range. Breaks out right here, and very quickly goes up about 10 pips, and within the next hour, another 10 pips. But the point is, very clear and predictable pattern using our tools. And you can also, for instance, on the CAD here, draw your fibs, and when it hits the fib target on the bottom, in this case it never did, let's try to find one that does. This pound right here from this move to this move. Notice it goes up and hits the fib target. Now this index really doesn't exist anywhere else. Some hedge funds, institutions, and huge money managers that trade billions of dollars might have something similar, but our currency indexes don't exist in the wild, and yet fib targets still work, which kind of proves what I've always thought is fib targets are just one of those natural things that just happen to work, not because everyone uses them, just because when the market has gone up too far, there's no buyers left, and basically these areas kind of identify that. So at 3 to 310, the pound's likely to pull back, maybe not that much because the trend's pretty strongly up, but it's gone up, pulled back. Notice it found support at the 38% fib retracement level, went up to the fib target, stalled. At 3 o'clock, let's go and take a look at what currency might be likely to go up or is trending up. Now the euro is obviously trending up, but it's already gone up for an hour and a half. The dollar is also trending up and has had a little slight pullback here. It's also not near its upper containment bands like the euro is. The Swiss is also kind of inching its way up. These two currencies are trending down. This one's down, this one's down. So basically you could sell the pound dollar, you can buy the euro pound, although I wouldn't do it because it's already up a lot. But probably best of all is if the Swiss does break out and you sell the pound at the tip-top likely high, the pound Swiss is likely at 3 o'clock to come down the most. I like to take trades that are likely to give me the most profit. So here's 3 o'clock when I said, and you can see, you know, you have this nice little drop here, pullback, drop, pullback, big drop. By using the predictive nature of our indexes, because you can actually see each individual currency as a chart, you can find areas that are very likely to be the max high or the min low and get into trades at those points. Now at this point, if you're looking at this actual chart, you can see our perfect oscillator hit the plus 80. Typically price reverses at or near the plus 80. You could say anywhere from maybe 75 to 85, it reverses. This one, it comes down, goes above this high, you're likely to get a pullback to the hourly, which happens all the time. Notice also yesterday or last night, the plus 80 level, what happens? A pullback. And that's why I call it the perfect oscillator, because it's absolutely amazing. It knows what the volatility is of each currency at every time of the day, and it knows what the most it's moved in the last 20 days is for that time of the day, and it shows you visually on the chart how far it's moved compared to how far it's moved in the past for that time of the day, and it doesn't use number of bars back, look back periods like most oscillators do, which are garbage. If one big bar falls off the end of the 14 bar or whatever bars back you're using, then the oscillator you're using can be totally screwed up just by that bar falling off the end. Ours does not use that. It just compares the price to how far away it is from X price, and I'm not going to reveal our proprietary indicator, compared to that over the last 20 days, and it's absolutely amazing. And typically our Bollinger Bands around there, when you see a strong trend, can also let you know when to get into a trade. When it, let's say it's trending down, if it hits the upper Bollinger Band, these are areas where you can get in. Notice right here and right here, corresponds to here and here, both causing small profit and huge 50 pip profit on the second one. Obviously it doesn't work every time. This would be a sell. Price only pulled back 10 pips. And you can see it stayed above the zero line, which is basically telling you that, you know, it's more likely to reverse. If it comes back below that and comes down, then you have, like you can see right here, a home run. It broke that zero line, and therefore there's a lot more profits to be had.